I'm Charlie Fuchs and you're watching this week's Weekly Wrap-Up. I'm on the line with Riccadonna, Senior US Economist at Deutsche Bank, to share his insights on the past trading week. Onlookers waited with bated breath for the outcome of the Federal Open Market Committee meeting on Wednesday. Despite the excitement, a seemingly complacent forecast from the Fed jarred with the views of many economists who highlighted the fact that a falling GDP suggests a shrinking economy and high unemployment. What are your thoughts on the Fed's apathy towards the current US economy?
Well, the Fed is looking at what happened in the first quarter in the U.S. and casting a very thin ear to that development. And what we saw in the U.S. was a very severe winter, which weighed on things like retail sales, other consumption, transportation, travel, even home building. And so the economy contracted in the first quarter of this year. Currently, it's reported at a 1% contraction, but that's likely to be revised even lower when we get the next print on Q1 GDP, which is coming up next week. But the Fed is ignoring this because they're looking at current quarter activity and leading indicators of the economy, and those indicators tell us that this was just a one-time soft patch and that we're seeing a significant rebound in the current quarter. So purely based on the number of hours worked in the economy, which is a good sort of backdoor double check for GDP forecast, it tells us that GDP in the current quarter is growing at least at a 3.8% pace. Our view is it'll be even stronger, something north of 4%. So what we really have to do is just look at the first quarter and the second quarter, average them together, and that tells us that the economy is still very much on track and potentially accelerating slightly relative to how it performed in 2013.
Despite a strong effort by football fans, mass sales of replica football shirts wasn't quite enough to save British retail sales from their first drop since January. Despite this, there is still a healthy demand for British retail goods, as the drop didn't affect the year-on-year sales data, which confirmed the UK is up 3.9%. What do you think about the 5-year high of the pound?
Well, we've had a very beggar thy neighbor type of situation in most of the major global currencies, as central banks have been looking to ease policy to further stimulate activity. But the flip side of that is the risk that we can create asset bubbles and potentially cause too much inflation to develop in the economy. That hasn't been the problem over the past 5 years because global growth has been so weak, but we're starting to see things now finally normalizing, and so this, along with that normalization, comes the need for a normalized monetary policy, and it looks like, at this point, the Bank of England might be leading the way, as Carney earlier this week suggested, and last week as well suggested, that potentially London real estate prices are a problem, and the central bank may need to adjust interest rates in order to address that situation. So it's not necessarily that the British economy is overheating, but they are concerned about asset bubbles, particularly in the real estate market. And so, with the Bank of England suggesting they're finally moving in the opposite direction of most of the other central banks, which continue to ease, this means that the currency is going to strengthen, and I think that this trend will continue, not only for the British pound, but also for the U.S. dollar, as the Fed becomes more serious about backing away from quantitative easing and eventually raising interest rates, but I don't think we'll see the U.S. Fed raising interest rates probably until the middle of next year. Nonetheless, these currencies are driven by interest rate differentials. Bank of Japan's going easier. European Central Bank is moving easier. Bank of England's moving to tighter policy, and the U.S. Fed is very slowly turning the rudder towards tighter policy as well. And so we will see the currencies reflect these divergent central bank directions, and I think this will be the prevailing trend for probably the next 5 years.
Bank of Japan Governor Haruhiko Kuroda said yesterday at the Upper House Financial Affairs Committee that the central bank's asset purchase program is a part of its quantitative easing and is not intended to finance government debt. Do you think this is the right course of action?
I think it is the right course of action for Japan. Now, of course, quantitative easing lowers interest rates, so in a sense that does help to finance government debt, right? If we have a lower interest rate, we can finance a higher debt load. But that's the side effect. The real benefit is that these quantitative easing measures generally lead to a weaker currency. We certainly saw that in the U.S. when the Fed was in the middle of its QE program. The trade-weighted dollar fell to basically a 3-decade low. Now, why do we care about weak currencies? Well, weak currencies stimulate the export sector. The export sector, obviously very important for the Japanese economy, so they need to continue to embark on this asset purchase program or quantitative easing to further weaken the yen, to make Japanese exports more competitive in the global marketplace, and therefore help to stimulate manufacturing, shipping, employment, etc. In the Japanese economy. So I think they're moving in the right direction, but Japan has had so many problems for so long that I think they really have to be very conscious of holding their foot on the accelerator longer than they possibly think is necessary in order to finally pull out of this really 3-decade-long slump.
Carl, thanks so much for your comments. That's all we've got time for on this week's Weekly Wrap-Up. Have a lovely weekend and continue to click back on the Dukascopy site for changes in the trading day.